Okay, let's continue on. Number 22, it reads, accrued product warranty. Foster's Manufacturing warrants its products for 1 year. The estimated product warranty is 2% of sales. Assume that sales are $1.5 million. On February 7th, a customer received warranty repairs requiring $325 of parts and $120 of labor. Journalize the adjusting entry for January 31, the first month of the current fiscal year, to record the accrued product warranty, and then in B, it's that warranty work. So first, 1.5 million times 2% is an accrual of $30,000, expense and payable. Did 1.5 million in sales in January, we accrue 30,000. Well, on the 7th, right away, they used some supplies, there was some wages, all of that would go against that payable, a debit to the warranty payable. Number 24, contingent liabilities. Several months ago, this industry experienced a hazardous material spill at one of its plants. As a result, the EPA fined the company $240,000. The company is contesting the fine. In addition, an employee is seeking $220,000 in damages related to the spill. And lastly, a homeowner sued the company for $310,000. The homeowner lives 35 miles from the plant, but believes the incident has reduced the home's resale by $310,000. This company's legal counsel believes that it is probable that the EPA fine will stand. Counsel indicates that an out-of-court settlement of $125,000 has recently been reached with the employee, and the final papers will be signed over the week. Counsel believes that homeowner's case is much weaker and will be denied in favor of the company. Other litigation related to this spill is possible, but the damage amounts are uncertain. So this is a contingent liability, and they tell you use the account damage, awards, and fines. So with number 24, we've got the our debit is to damage, awards, and fines, and then there's the $240,000 for the EPA. That's a payable, and then also the $125,000 that they settled on that employee. So, you got your fines payable, and you got this other litigation payable for a total expense of $365,000. All right, let's look at the last problem, or the only problem assigned out of this chapter, problem 1A. And there's a whole bunch of dates there, and it says journalize these transactions. Okay, so March 1st, it reads, purchase merchandise on account, $225. Debit inventory, credit accounts payable. The 34th issued a 30-day note, 8%, $225. So what they did was they took it out of accounts payable and moved it into a notes payable. On April 30th, paid Kirkwood Company the amount owed on the note of March 31st. So the note was $225. There was the note. It's a 30-day, 30 over 360. Interest rate is 8%. We got $1,500 of interest. So the total cash is $226,500. June 1st, we borrowed $600,000, issuing a 45-day note, 6%. Got the cash, notes payable. July 1st, purchased tools by issuing a $50,000 60-day note, which discounted the note at the rate of 6%. So it's a $50,000 note, 60-day note, 60 over 360, 6%. There is $500 of interest right up front. The note still is $50,000, but what we didn't get is a total of $50,000. In this case, we got tools. Our other exercises, we debited cash. Well, in this case, we got the tools with that note. So we got $49,500 of tools. On the 16th, paid Triple Creek Bank the interest due on the note of June 1st and renewed the loan by issuing a new 30-day 7% note for $600,000. So they took it out of notes payable, and they put it right back in. So I'm not sure that was necessary. If you had an account specific to the first note and then a new account number for the second one, that's one thing. There was the initial $600,000 note. It's a 360-day year, 6%, $4,500. So we actually had to write a check for cash for $4,500. Okay, on August 15th, we paid Triple Creek Bank the amount due from the note, right? So notes payable $600,000. It was a 30-day note, 7% at $600,000. That's a $3,500 interest expense. All cash is credited. August 30th, paid this company the amount due on July 1st. Well, that was due from the note on July 1st. Well, on July 1st, we borrowed $50, so credit cash, credit debit notes payable. On December 1st, purchase equipment from Green for $280,000, paying $80,000 cash and issuing a series of 10 9% notes for $20,000 each, coming due at 30-day intervals. Well, we bought $280,000 worth of equipment. They paid $80,000 in cash, and the rest of it was going to a note. On the 22nd, they settled a product liability lawsuit for $40,000, accrued the loss in litigation claims payable account. So now we're booking the loss. It's an expense typically, right? And a credit to the payable. On the 31st, they paid the amount due to Greenwood on the first note in the series. On the first note, well, we had to pay $20,000, and we are paying $20,000 on that 30-day note. That's because it's only been there for 30 days. At 9% is $150. So our cash is $20,150. Moving on, so that's journalizing all the transactions. Journalize the adjusting entry for each of the following accrued expenses at the end of the year. Product warranty expense, it says, of $65,000, so that goes to a liability. And then this is a big one. Interest on the 9 remaining notes owed. So we have to accrue this, right? So there is $280,000. We took away the cash. That was what we paid. We've already paid one of it. So now we are down to what? $180,000. 280 minus 80, that's 200, minus another, minus another 20,000 is 180. So 180 times 9% times the 30 over 360, and we get to our 1350. So we'll do this here a minute. So with your calculator, you take 180,000 times 0.09 times 30 divided by 360. Oops. I'm having trouble here with my calculator. 180 times 180,000 times 0.09 times 30 divided by 360 is our 1350. Sorry, folks. My fingers weren't working right on my calculator. That's our 1350. So that's the last of those notes that we need to pay, and that way we can get those accrued for a future payment. So we got the 1 month that they were out there, all 180,000 at 9% for a month is now accrued in the payable account. That takes care of the exercises and the problems from Chapter 10. Thank you.